Hello everyone, we are going to learn about break-even analysis in this video today. What do you mean by break-even analysis? A break-even analysis is a financial calculation that weighs the cost of a new business, service or product against the unit selling price to determine the point at which you will break even. In other words, it reveals the point at which you will have sold enough units to cover all your cost. It is known as break-even analysis. Why it is important to know what is the break-even point? The importance of break-even analysis. The first need is to know the pricing. Businesses get a comprehensible perspective on their cost structure with break-even analysis. With that understanding, businesses can stake prices for the products that not only cover the fixed and variable costs but provide a reasonable profit margin as well. Then in order to take appropriate decision, it is necessary to know the break-even analysis. When it comes to new product and services, operational expansion or increased production, businesses use break-even analysis to help them make informed decisions surrounding those activities. Then in order to reduce the cost, it is essential to know what is the break-even point at which we can get no profit or no loss. We can identify the areas where they can reduce cost to increase the profitability of the concern. The next point is to measure the performance. Break-even analysis is helpful tool to ascertain where they are when it comes to achieving their short, medium and long-term goals. So these are all the points regarding break-even analysis. Then there are some components in break-even analysis. What are the components? There are totally 5 components in break-even analysis. The first one is fixed cost, variable cost, revenue, contribution margin and the break-even point. So these are all the various components in break-even analysis. Now we are going to learn how to calculate break-even point. So the formula which is used for calculation is fixed cost divided by price per cost minus variable cost. Let me tell you an example to understand the calculation. Company X sells a pen. The company first determines the fixed cost, which includes a lease, property tax, salaries. Everything sums up to 1 lakh. The variable cost links with manufacturing one pen is rupees 10 per unit, which means the variable cost for producing one pen is rupees 2. So the pen is sold at a premium price of rupees 10. Therefore, to determine the break-even point of company X, the premium pen will be, as per the formula, fixed cost here is rupees 1 lakh. The price per pen, which means the price per cost is rupees 12 minus the variable cost is rupees 2. So 12 minus 2 you will get 10. So divided by 1 lakh by 10 is rupees 10,000. So the break-even point will be rupees 10,000, which means the given variable cost, fixed cost and selling price of the pen, company X would need to sell 10,000 units of pen to break even. So it is mandatory for the company X to sell at least 10,000 units to reach its break even point. So this is the method of calculating break even point for any concern. Just to remind the formula once again, break even point is equal to total fixed cost divided by the difference between the price per unit minus the variable cost, so that you will get the break-even point. So this is the method of calculating break-even point. Thanks for listening.